What outrageous charts will be shown and what outrageous things will be said? I have no idea, so let's get started. And we begin with a broad market view. Since the start of the year, this is year to date, through the market close of April 24th. This is your big picture view. And we've got charted here, side by side, major asset classes and the ETFs tracking them, from Bitcoin to commodities to global real estate to U.S. stocks and U.S. bonds. The runaway leader since the start of the year has been commodities, SDCI, ahead by almost 27%. It continues to sizzle higher as inflation, the Iran war continues. Contained within SDCI is a basket of different commodities. Of course, you got all the energy commodities in there, oil, gasoline, etc. By the way, SDCI is one of the best core diversified commodity ETFs out there, best in class, 5-star rated. And we just did an interview with Paul Bayaki over at SS&C Alps in our Spotlight series. Be sure to check that out. He goes into depth talking about SDCI, how it's built and engineered, and why it's been able to do so well. So be sure to check that out. It's right here on this channel. Some of these other major areas, stocks, SPY, continue to climb higher. You'll see that just about a month ago they were down, but they've made a pretty impressive run and staged a nice rebound as investors have sort of getting tired of the Iran war, maybe a little fatigued there, and maybe not as freaked out as they were when the Iran war started. But we'll take a look sector-wise what's going on in S&P 500 in a second. Global real estate has also performed very well, up almost 9% since the start of the year. That's not even including the dividends. So maybe you're going to get maybe another, if you hold that for the full year, maybe another 3 to 5% dividends, roughly. So total return on global real estate is looking pretty good right now. And then Bitcoin, IBIT, which is an ETF tracking that, down 11%. And that's really the only area that is negative so far in 2026. So that's your big picture view. In terms of industry groups, we've got 7 up, 4 down. The leaders, XLE, Energy, XLB, Materials, and XLI, Industrials. Those are the winners. We're going to take a look at XLK, which has staged an impressive rebound over the past several weeks. Stay tuned for that. I've got a couple of charts that I'm going to show you. And then some of the laggards, healthcare, financials, and communication services. Wall Street Journal ran a piece all about the safety, and I put that in quotes, safety retirement portfolios, specifically dealing with 60-40 allocations, also known as the popular 60-40 fund or portfolio mix. And so the question in this particular article is, do safe retirement portfolios need to rethink this allocation of 60-40 portfolios? And I've talked a lot about this on this channel about safety and safety protocols for investors, especially those of you nearing retirement or already in retirement. And you should know just by the recent performance of 60-40 portfolios that they are not safe and that they can lose value. And sometimes they lose as much value as an all-equity portfolio, as we see in this chart over the past month, AOR, which has a 60-40 allocation, 60% stocks, 40% bonds. AOR fell almost as much as the S&P 500, which is an all-stock portfolio. So much for safety, especially during turbulent times, volatile markets, downtrending markets. So much for safety when it comes to 60-40 strategies. They do not, I repeat, they do not provide downside protection in the manner that you may expect or think. And it's very important to understand minimum safety standards when it comes to investing. The whole purpose of your safety bucket within your overall portfolio, and these are the 3 cornerstones of an architecturally sound portfolio, but your safety bucket, the assets that you put in there should have these 3 elements or attributes. They should provide liquidity, diffuse market volatility, and provide 100% principal protection. You do not get any of this with 60/40 portfolios. They do not diffuse market volatility, and they do not offer principal protection. So therefore, you would never use a 60/40 portfolio in the safety portion or safety container of your investment portfolio. You can use 60/40 elsewhere if you want, but just know that it has no place in an investor's safety bucket, and especially those of you with large retirement accounts that may be running with 60/40 portfolios looking for safety, definitely you want to rethink that strategy. Now, in terms of the non-core investment portfolio, because we talk a lot about safety, non-core is really an interesting area because it gives you a lot of leeway as an investor to be able to be more concentrated in nature with your investments. You can trade, you can use leverage, you can use individual stocks, there's a lot of leeway that you have. You can use non-core asset classes like cryptocurrencies, which are still in the midst of developing and becoming a major asset classes. So these all go in your non-core portfolio. We're going to take a look at some ETFs that would fit into this bucket. One of the standout performers over the past month that really, I think, deserves your attention are a couple of ETFs. Soxal, which is a familiar ticker symbol, tracks semiconductors, bull, 3X shares from Direction. This ETF has gained over 133% over the past month alone. Now, you'll notice in late March, it was down as much as 25%. Those of you that were contrarian traders getting into Soxal when it was beaten up, and if you had the guts to hold it, you've made some money. Even if you didn't hold it for a month, if you held it even for a couple days in this uptrend and realized some profits, you did well, likely. And then you've got some of these other ETFs that track that same area, semiconductors, SMH, which has no leverage, and then TSXU, which tracks semiconductors. Top 5 stocks. TSXU is the Direction Daily Semiconductors Top 5 Bull 2X. So it's a little bit different than Soxal because it only uses 2X daily leverage, but it's also more concentrated in the fact that it tracks just those top 5 semiconductor stocks within the NYSE Semiconductor Top 5 Equal Weight Index. So keep that one if you're a semiconductor bull. Keep TSXU on your radar because it's another interesting way to play this particular area if you're a bull. Of course, you have the bearish version too, TSXD, for those of you that may have a less favorable view of semiconductors. I also want to point out single stock ETFs, which continue to boom. And we've got an upcoming interview with Sean Edwards at Direction. And we've also been publishing on this channel, you may have noticed, a lot of shorts. These are videos that are 3 minutes or less in length. One of the shorts that we published on April 20th, and I'm very proud of this, we've been alerting you with these single stock ETFs just a few days before these actual individual stocks report earnings. And we had Intel reporting earnings on April 23rd. Well, we told you about this. We alerted our audience, we alerted ETF traders on April 20th, 3 days before, about LINT, which is a Direction ETF, the single stock ETF. It's a bull ETF linked to Intel from Direction. LINT, L-I-N-T, and this particular ETF soared. It soared almost 50% on April 24th alone. Of course, Intel reported fantastic earnings on April 23rd after the market closed, but we alerted you about LINT, and so you're going to be seeing more shorts. There's a couple of other companies that are going to be reporting earnings over the next couple of weeks, so be on the watch if you're looking to participate in potential upside. Some of these specific individual stocks get that pop when it comes to earnings. Do pay attention to our shorts right here on ETF Guide TV. Bank of America just came out with a stark message for silver investors, and man, it was good. The bank said that they are projecting that silver could reach anywhere between $135 to $309 per ounce before the end of 2026. Holy schmoly. That's not a typo, folks. That is one heck of a bullish forecast. I don't know if I've ever seen a more bullish forecast on silver than this. So Bank of America getting in on silver. And silver, if you haven't been paying attention, has been one of the best performing areas over the past year. Now, it's cooled off this year, but even if we span out and look at the 1-year performance on SLV, which tracks physical silver, it's still up over 126% over the past year. My point to all of you, and hopefully you know this already, but for those of you that don't, I'll mention it, that the combination of silver mining stocks plus physical silver has been and continues to be the better play on silver. Way better than just physical silver alone. And here's the proof. The 1-year chart doesn't lie. SLVR from our friends over there at Sprott Asset Management, this ETF has done way better than just physical silver, and it's because it combines physical silver with silver miners. So if you're a silver bull, SLVR, again, is the better way to play silver, in my opinion. The numbers, again, don't lie. They support that argument. And SLVR has outperformed physical silver by a whopping 40% over the past year alone. SLVR, by the way, was just named one of the most innovative commodities ETFs in 2026. Pretty prestigious award from the ETF industry. And then also, it recently crossed $1 billion in assets. I remember when this fund, when it first launched, it had under $100 million. So pretty impressive. There's a lot of interest in silver. And if that forecast from Bank of America, uber bullish forecast comes true, there's going to be a lot of happy silver bulls. Finally, I like to remind you of the big money, what it's doing and how it got there. Look at the top 10 billionaires globally, and 8 out of 10 made their fortune in the technology sector. And they dominate. They continue to dominate. Elon at the top, $647 billion net worth. Wow, that's a lot of bananas. Just behind him, Larry Page, Jeff Bezos. We know these names. They're associated with the great craps. The great caps, not craps, caps. that was a slight word slip up, but you know what I mean. The great caps. The Googles and the Microsofts and the Facebooks. Well, actually, it's Meta. And so the NVIDIAs. So the point here is, from an investing perspective, this is not going to change. The digitalization of everyday life and of business will continue, especially as AI, electrification, all of that continues. Of course, all the things that's going to require, the commodities behind it, right? The copper, the lithium, the rare earths, all these things that are going to require, there's a lot of money yet to be made and fortunes yet to be made. So use this as a point of reference for your own investment portfolio. I think orientating that portfolio towards these growth areas, technology, semiconductors, AI, and of course, all those other things that are behind that, the commodities, very important if you want to get ahead and, of course, stay ahead. Wrapping up today's show, watch some of our upcoming episodes. We have a new one on ETF battles that will be dropping on Monday. And we've got other episodes that just released. First Look ETF with the New York Stock Exchange. Check that out for the latest on the innovators in the ETF industry, some of those new ETFs that are movers and shakers. Our April episode is out. And then, of course, Metals in Motion, our last episode, also for April, just focusing on a very important area that's starting to get some noise and attention, rare earths. So be sure to check out that episode. And that just about does it for today's episode. Hit me up in the comment section below. and let me know how you enjoyed today's episode. What would you like to see? What would you like me to chart on future episodes? Also, for ETF battles, what would you like to see in upcoming episodes? Give me your ETF ticker matchups. And also, be sure to hit the description section. I've got links to our online classes. I've got links to some of the ETFs that we talked about on today's program. And don't be a stranger. Thanks for watching. We'll see you on the next episode. I'm Ron DeLegge. Take care.